I published a blog post yesterday, March 4th, 2026, discussing some of my trades over the past few days. I've been a very active seller of stocks for several weeks now. A link to my blog post can be found in my profile section here at YouTube. I am in a risk off mode for stocks in part due to my age, financial condition, and financial objectives that are unique to me, which emphasize capital preservation and income generation as my two primary objectives, and also to my opinions, which I've stated many times here and in my blog post, that most stocks are overvalued and do not properly reflect the significant known risk to the U.S. economy that include a weak labor market that is failing to provide enough jobs for new entrants to the labor force, stubbornly high inflation that is likely to rise, in my opinion, supply chain disruptions caused by mass deportations of immigrants who are here unlawfully, the uncertainties that are created by the on again, off again Republican tariff taxes on U.S. importers and consumers, and the recent surge in energy prices resulting from the war in Iran. The decline in energy prices last year was one of the restraints on the inflation in 2025, and the rise in commodity prices just over the past few days have already taken back and then some those declines. While Iran's naval force has been decimated, some leaders have been killed, and some other degradations have occurred in Iran's military power. The U.S. and Israel are running out of targets for their very expensive missiles as the regime forces in Iran have scattered and gone into a decentralized command structure. Iran appears to have substantial drone and missile capacity that can effectively close the Strait of Hormuz to commercial ships carrying crude oil and liquefied natural gas. And about 25% or so of the world's supply is of crude oil and liquefied natural gas has to pass through that strait, and it's very narrow. It is far from clear to me whether the U.S. and Israel have and will be able to render Iran incapable of striking targets near its very large and coastline that includes the Persian Gulf, the Strait of Hormuz, and the Gulf of Oman. Just look at a map. This kind of target-rich environment for Iranian drones and missiles include oil and natural gas shipping, traversing or needing to traverse the narrow Strait of Hormuz, and U.S. installations and embassies throughout that area. Maybe our generals had not learned the lesson clearly taught about drone warfare in Ukraine, where drones were able to, that are relatively inexpensive, were able to destroy very large and more expensive military equipment, including many Russian warships. I also do not view it as reasonable, as the Republicans are predicting, including Trump, that Iranians are going to rise up against the regime. Unarmed protesters will simply be killed as they have in the past until the protests stop. A civil war with extreme levels of chaos is more of a possibility over the next few years. Regime change in a nation of over 90 million people is not likely to happen with missile attacks, and that's over a very large geographic area. So given the new recently created uncertainties on top of the ones that already existed that was causing me to restrain my risk taking some that existed prior to this latest war. I have reduced my allocation to stocks and increased my allocation to alternative yield assets. The main shift is to increase my weekly purchases of Treasury bills, where I prefer to hide for a while, at auction, and I'm spending about $40,000 per week investing in those Treasury bills, spread over the 3, 4, and 6 month bills. And that's simply an alternative to keeping funds in lower yielding money market funds until there is a significant decline in stocks that makes the risk reward balance for me more favorable than it is now. I'm mostly using proceeds from maturing corporate bonds and Treasury bills, and to a lesser extent CDs and Treasury notes to fund those Treasury bill purchases. I have increased slightly my allocation to exchange-traded first mortgage bonds, and I've quit buying corporate bonds because the yields are just too low at the moment. The increase in my T-bill allocation is not a satisfactory option, even from my perspective, given the relatively low yields. Recent 3, 4, and 6 month Treasury bill investment rates have been bunched together near the midpoint of the current federal funds range of 3.5% to 3.75%, which indicates the opinion of the purchasers that the Fed is not going to cut the federal funds rate by 25 basis points within the next 6 months. When I have to adjust the Treasury bill yields for inflation and the taxes that I owe when owning them in a taxable account, the real return is barely positive. I refer to that kind of result as running in place, which is fine for me. I can run in place for the rest of my life, but not for anyone who needs to grow their capital through investments. Since I use a latter approach for my ownership of Treasury bills, corporate bonds, and Tennessee municipal bonds, I will always have a constant flow of proceeds which I could use to invest in stocks when and if the opportunity arises, and I'm comfortable in doing so under the then current economic conditions as I assess them.